Mistakes are, of course, a part of life, and investing is no different. It's pretty rare for somebody to start investing and from day one make all the best decisions possible for their situation. So, today, by viewer request, I'm going to share one of my biggest investing blunders and hope that you can learn something from it. Ladies and gentlemen, welcome to the Fiscal Philosophy YouTube channel. I consider myself to be a value-focused investor today, although this was not always the case. In 2021, the majority of my assets or worth, such as it was, would have been in either cash or physical real estate. And today, of course, the majority, I would say, is now moving towards stocks instead. But at the time, in 2021, my thinking, or I guess like my default setting as a person was, real estate and physical assets like that. These are real things that you can control, and somehow that makes them better investments because you can physically go to the property and you have more direct control over it in theory and all that. But that's not really the case, especially when you realize that stocks represent pieces of real existing entities that employ people to do tasks to create economic value, okay? That's what stocks are at the end of the day. But in 2021, it was a different world, it seemed like. Euphoria was hitting a fever pitch, and all the squeezes were squeezing and all that. And meme stock fever was at an all-time high. And here's the thing. I was hearing even people outside of investing circles talking about all the different, stock-related things going on with, GameStop and certain cryptocurrencies and things like that. So, of course, I was starting to feel a little left out sitting over there in the corner with my cash and real estate and my 9-to-5 job. And so, of course, I start browsing different investing forums, including Wall Street Bets of all places. And I decided to open a brokerage account at Vanguard because I'd heard of them and I knew they were considered trustworthy. For some reason, people were starting to, say that Robinhood was out to steal your money or whatever because they had halted trading on GameStop or something like that. So it's like, oh, don't get Robinhood, they're bad. So I'm like, oh, okay, well, I've heard of Vanguard, they seem good. And I put a few $100s into AMC. And I was like, oh, sweet, I'm participating in this cool craze. And then I kind of lost interest for a while and forgot about it. Came back to it a little later and found out that my my buy of AMC had 11x'd. Okay, so I was literally right out the gate 10xing my money. So, I kind of thought, okay, maybe better to be lucky than good. Sold what I had, and then I was like, maybe I can make lightning strike twice here. So I put a few $100 into Wish, which is context logic, and you can see at one point in time, this is adjusted for reverse splits, by the way. The stock was as high as $902 at a split adjusted price. I think the actual price that it was back then was like $14. But to not get delisted and stuff, they've had to do a bunch of reverse splits to keep the share price at a certain level. And now it's sitting here at $5. But I think, I think split adjusted, it would be like 20 cents or something stupid like that. So, and at the time when I got in, I think it was like $13 or $14 maybe in actual dollars. So, anyways, with that, I was playing with what I thought was, house money. So like, I was viewing it, I guess, more or less as kind of like a gamble, but I had it on good authority that Alibaba and Amazon had put in purchase offers to buy Wish out before that, to the tune of 10 to 15 billion dollars, right? And I think back to other companies like Netflix, and think, oh man, remember when Netflix was kind of new and Blockbuster had the chance to buy them and didn't, and all this. So I was thinking of that, and I was like, oh man, this Wish thing, it might really have legs. However, the one thing I did not do was I did not consider whether or not a $10+ billion acquisition, like, if somebody did buy them out for that price, I didn't really consider whether or not that would have been smart for the acquirer by looking at the financial performance and, a reasonable financial future for something like Wish. I didn't see it for the business it was. I saw it for the news or noise or whatever you want to call it surrounding it, the rumor, whatever, the sentiment. And so, without much further ado, I'm going to show you why this was bad and, maybe how I could have avoided making a very, very big, well, a few $100 mistake. I think one of the biggest mistakes people were making in early 2021, which if you look at this chart, that's when revenue was basically peaking, and it's fallen off considerably from there, is there was an assumption that the recent revenue growth being reported by Wish was sustainable and would continue into the future. Of course, this overemphasis on revenue, I think, really contributed to a lot of the enthusiasm around Wish, but revenue isn't everything, and just because revenue's grown recently doesn't mean the growth will continue going forward. First major red flag, I think, for Wish and their the future of their stock could have been noticing that their selling, general, and admin was going up in almost direct correlation with their revenue. And in each of the trailing 12-month periods, you can see that the SG&A expense actually exceeded gross profit and was well over half of their total revenue. And, of course, the operating expenses followed a pretty similar trajectory, going up in line with both the revenue and the SG&A expense. And in fact, the operating expenses even tended to eclipse the SG&A expense. So this means that even if they had 100% gross margins, they still wouldn't actually have been generating a profit or positive cash flow. But as a fact, they did not have 100% gross margins. Now, their gross margins looked pretty good at the time, but they were already starting to decline somewhat. And if you combine declining gross margins with expanding SG&A and operating expenses, what you have is the need to basically destroy economic value in order to grow revenue. That recipe means bad things for shareholder returns in the long run. If you want good shareholder outcomes, make sure you psycho crusher that like button, subscribe to the channel, and slam that notification bell. So, the big takeaway here, in my view, is that, and this is the lesson that I think I learned from this, euphoria-based gains, they tend to be short-lived. Now, they can last a little bit longer than they did with Wish or with AMC or any of that, but generally speaking, gains that you make just based on euphoria can evaporate very quickly, all right? However, I think the more sustainable gains, the long-term gains, the gains that, make, say, Warren Buffett into Warren Buffett are the gains you get from the underlying business actually generating real economic value for shareholders. So now I'd say I take an approach that's basically the opposite of the one that led me to buy Wish stock in the first place. I look first at the economic value that a business has generated and, what I view as its future potential for generating economic value going forward. And I look for, periods where there's negative sentiment on companies that generate real economic value. And I view those as opportunities. Now, what it means is, again, fear is also one of those things where, losses that you take based on fear or negative sentiment, if there's real economic value, can also be pretty short-lived. And so I have bought stocks and seen them go down a lot, continued buying them, and then saw them go back up. Because at the end of the day, it's really about the economic value that they generate in the long run. It's about, do they turn a profit? Is there positive cash flow? Do they have assets? These are the things that I think matter more. And eventually, even if the market's temporarily negative on them, somebody will look and say, oh, you know what? This company actually makes a lot of money. I think it's worth, holding some shares of it, versus whatever the negative news is around the time that's pushing the price down. So that's really all I have to say about my blunder buying Wish back in the day and what I learned from losing a little bit of money on Wish stock. I hope you'll comment down below letting me know what your biggest investing blunder was. Now, also, feel free to join the conversation on Discord. Link is in the description. Always love to hear from you there. On a more personal note, I often point out some of these same red flags now when I cover stocks that I see getting a lot of hype, either on YouTube, Wall Street Bets, etc. So I really want other people to potentially avoid making some of the same oversights that I made back in the day. Let me know what you think about that.